Hi, I'm Jarrad Brown, Australian expat financial planner. Welcome to my video series where we explore some of the tough personal finance questions for Aussies all over the world. Today I want to share with you some of the rumours and really dive into exactly what's going on in terms of borrowing money in Australia. You may have heard that it's about to get tougher, and we're already seeing some of the changes implemented to actually obtain a loan or refinance existing loans if you're looking to buy property or refinance existing property back home in Australia. So before we look at exactly what those changes are, what they might be, and what you might want to think about doing about it, let's just have a look at why the regulators in Australia, why the Australian government is really looking to change anything at all. Now, to set the scene, we've got record low interest rates in Australia. The cash rate is at 0.1%. Owner-occupier rates on home loans are in the high ones, even trending towards the mid ones these days. We're seeing investment rates in the high ones and the low twos. These interest rates are at record low levels. They're certainly not going to stay around forever, but certainly for those that are borrowing or those with existing debt, naturally quite an attractive time to be repaying those loans. Now, with that record low debt, we've also seen various home builder incentives, various other schemes in the different states and territories to encourage more and more people to go out, buy or build their own home. A lot of them have been house and land packages, and that's meant that we also now have a record level of new home starts. Now what that means is registrations for new houses to be built. So all of these incentives have meant that particularly first home buyers could get into their own home a bit faster, could go out and buy an investment property even in some cases with some of the incentives, and it just allowed them to accelerate that journey. Now what that's also meant with these low interest rates is that people are borrowing, in the eyes of the regulator of APRA and the Australian government, too much money. We've now got about 22% of households with more than 6 times their annual income in debt. And now we're not talking about personal debt, we're just talking about mortgages here. Now, what does 22% actually mean? Well, to put that into context, the long-term average is about 15%. So it's very high. There are concerns that not enough borrowers, not enough Australian households are really crunching the numbers around what it will mean for them with their repayments if and when interest rates do rise, which naturally they're going to do in future. So that gives you a bit of context as to why there's some concern. So let's have a look at what the regulators, what the banks might actually do to start to cool this borrowing. So firstly, let's have a look at what's already happened. We've seen an announcement recently that from the 1st of November, or the end of October, APRA would basically ensure that the serviceability buffer rate would increase from 2.5% to 3%. Now what the buffer rate is that is the margin or the buffer that the bank or Australian lender needs to apply to your assessment rate, or to the rate you're borrowing at, when they're looking at whether you can afford to make the repayments. So if, for example, you're borrowing money at 2.5% and the buffer rate is 3%, then the bank needs to feel comfortable that you can make those repayments at 5.5%. So that increase means that you need to be able to afford the repayments at a higher interest rate, which is naturally going to reduce the amount that you can borrow. So it's, in terms of the rough calculations, they're suggesting that that might reduce borrowing capacities by about 5% for the average Australian household. Now that's a small step in the right direction, but it's very unlikely that's going to be enough for the regulators to really be comfortable about the level of household debt. So what else could happen? What other rules could they actually change? So given that it's unlikely that the serviceability buffer alone will be enough to really cool down the borrowing appetite, what else could APRA force to change in the market? One option, and again, this is all speculation, so please don't take any of this as gospel. These are really just some potential things that they might look to change in future. Now, one might be they could copy the New Zealand market, the regulators in New Zealand, and require a higher deposit for investors. So for example, instead of a 20% deposit, maybe they would require a 25 or 30 or even 40% deposit. Now that's a difficult one to enforce, because how can we really tell and be really sure that it's an investment property over an owner-occupied property? Are they buying a holiday house? It starts to get a little bit murky, so we think that's quite an unlikely change that they would look to bring in. What they could also look to do is cap the total borrowing per household. So for example, once you exceed a certain multiple of your income, that's it, no more borrowing for that particular household. So that's certainly an option. They could look to put in place other caps on investment debt. They could look to reduce the actual amount of income that can be included, or they could simply look to actually place greater restrictions, particularly on the loans that are in LMI territory. By that I mean loans where people are looking to borrow more than 80% of the property's value. Because naturally there are greater concerns there are greater risks there, because if your interest rates start to rise, there's very little equity in the asset, so the household has lower options or reduced number of options to actually repay that loan. So there's a number of things that could change. There could be plenty of other options that could change as well. So what should you do if you already have debt you're looking to refinance, or if you're looking to buy your own home? Well, there are a couple of options here, but it really comes down to acting sooner rather than later. Reach out to your mortgage broker, your advisor, start to look at getting a pre-approval in place. If you're looking to refinance, perhaps consider doing that sooner, because it is going to get tougher. There's going to be more documentation, there are going to be greater hurdles, and if you're an Australian expat, anyone who's tried to refinance or borrow money recently will know that there's quite a number of hurdles to jump through, quite a number of documents to be provided, so it's already not a terribly smooth, easy task, and it's probably going to get a little bit more cumbersome in future. So reach out to your broker now, start exploring your options, keep abreast of what changes are coming, particularly if you're looking to move back to Australia and buy your own home. Again, these changes could have an impact on you, so just make sure you're staying up to date with exactly what's going on. If you have any questions about these changes, what they might mean for you, what your options look like, please do feel free to reach out. If you have any questions, feel free to drop a note in the comments. Certainly love to hear from you. I hope this has been of value. I hope it's shed some light on exactly what's going on in Australia. If it has, please don't forget to subscribe, hit the like button, certainly be very much appreciated. Really appreciate you tuning in, and see you next time.